So this guy is worth over $100 billion, and almost everyone on the planet thinks they know exactly how he did it. They're wrong. The man's name is Warren Buffett. And look, Warren has a problem. Well, not a problem exactly. More like a secret. A very profitable secret that he's been hiding in plain sight for the last 70 years. Now his secret is this guy, Charlie Munger. Warren's partner, his best friend, his business soulmate. And Charlie once said something that nobody really paid attention to. Show me the incentive and I'll show you the outcome. Warren definitely paid attention, because here's what Warren Buffett actually does. He doesn't just buy stocks, he buys entire companies. And then he uses those companies, specifically their cash, to buy more companies. And then he uses that cash to buy even more. It's a machine, an infinite money machine that most people walk right past without ever seeing. One day, 1951, Warren is 21 years old and completely broke. Well, not completely broke. He has about $20,000 saved up from delivering newspapers, selling chewing gum door to door, and running a pinball machine business since he was 6 years old. But he has a plan. He shows up at Columbia Business School and hunts down a professor named Benjamin Graham, the man who literally invented the concept of value investing. Warren is obsessed. He read Graham's book, The Intelligent Investor, at 16 and basically lost his mind over it. Stayed up all night, read it twice, then read it a third time with a pen in his hand, underlining every single page. He takes Graham's class. He does every assignment. He argues, he pushes, he challenges Graham in front of the whole room. He drives everyone slightly crazy. His classmates think he's insufferable. Graham thinks he's remarkable. Warren isn't just studying the material, he's memorizing it. He's cross-referencing companies, tracking balance sheets in his head, connecting dots that other students haven't even noticed yet. By the end of the semester, there's no question, he ends up being the only student Graham ever gave an A+ to in his entire career ever. Warren walks out of that classroom with one thought: he needs to work for this man. Not because Graham is famous, not for the prestige, because Graham's brain works in a way that Warren needs to be around. You become who you spend time with, and Warren wants to become Benjamin Graham. Then he does something that would terrify most people. He asks Graham for a job, for free, just to learn. Not a salary, not an internship with a stipend, nothing. He just wants to sit in the room where the decisions get made and absorb everything. Graham says no. And here's the part nobody talks about. Graham's reason wasn't that Warren wasn't talented enough. His reason was that he already had too many Jewish analysts on staff and was trying to create more opportunities for them. Warren, being a kid from Omaha who grew up in a world without those kinds of barriers, was genuinely confused. He'd never even considered that might be an issue, but the answer was still no. Now Warren has to go back to Omaha, back to his father's house, back to the same quiet streets he'd been so desperate to escape, back to nothing. Except it doesn't feel like nothing to Warren. It feels like pressure. And pressure, for Warren Buffett, has always been fuel. He sits in his childhood bedroom, the same one where he used to track stock prices on a chalkboard as a kid, and he starts thinking, what's the one thing Graham taught him that nobody else has figured out yet? What's the edge that exists right now, in 1952, in the middle of nowhere, Omaha, Nebraska? And that's when he gets an idea. But there's an issue. He needs money. Not just his $20,000, real money. The kind of money that makes money while you sleep and keeps making money while you're on vacation and makes even more money on the day you die. So Warren does something nobody talks about in the highlight reels. He starts calling people, rich people, his father's friends, his dentist, neighbors, doctors, lawyers, his own family, anyone who would sit down and listen. And he gives them a pitch so simple it almost sounds stupid. Give me your money, I'll invest it. If I lose anything, I don't take a fee. If I make money above 6%, I keep 25% of the upside. It's a bet on himself, pure and simple. Some people say yes. Some people think he's a very nice kid who maybe needs a real job, but enough say yes. By 1956, he's 25 years old, he has 7 investors and $105,000. It's not enough to change the world yet. And then the story gets interesting. Warren starts buying companies, but not the ones you'd expect. He's not hunting for the next big thing. He's not chasing growth stocks or tech darlings. He's not sitting in some glass tower in Manhattan watching tickers scroll across a screen. He's buying ugly, boring, beaten-down businesses that everyone else gave up on years ago. Factories, textile mills, failing retailers, insurance companies, the kind of names that make people change the subject at dinner parties, the kind of businesses that don't have glamorous IPOs, the kind that smell like machine oil and old carpet. And when Warren walks into a board meeting for one of these companies, everyone assumes he's going to tear the place apart. Lay off workers, slash costs, sell the equipment, flip it fast. That's not what happens. Because here's what Warren sees that nobody else does. Every single one of these ugly companies has one thing in common: cash. Rivers of cash just sitting there, doing nothing, waiting for someone smart enough to use it. These companies aren't failures because they don't generate money. They're failures because nobody in charge knows what to do with the money they generate. And Warren knows exactly what to do with it. He realizes if you control the cash, You control everything. So he controls the cash. In 1965, he buys a struggling textile company in Massachusetts called Berkshire Hathaway. Everyone thinks he's completely insane. It's a dying industry. The mills are ancient. The machines are older than most of the workers running them. Cheaper factories in Asia are taking over. Labor costs are rising. The future is dark. Even Warren admits, years later, that buying Berkshire was probably a mistake in the traditional sense. He once said that if he hadn't bought Berkshire, if he'd just taken that same capital and put it directly into insurance, he'd have been worth significantly more. But here's what Warren understood that nobody else did at the time. The name didn't matter. The textile business didn't matter. What mattered was having a legal entity with cash flow and a board of directors that would let him run it his way. Berkshire was a vehicle, a vessel, and Warren was going to fill it with something completely different. But here's the thing. Warren doesn't care about the textiles. He cares about the cash flow. He takes every single dollar Berkshire generates, and instead of pumping it back into the dying mills, which would have been the obvious, logical, expected move, he redirects it. He uses it to buy an insurance company called National Indemnity, and that one decision changes everything. Now here's where it gets absolutely wild. Most people hear insurance company and their eyes glaze over. That's fine. That's actually exactly what Warren is counting on. Here's the thing about insurance that nobody talks about at dinner. Insurance companies collect premiums before they ever pay claims. You pay your premium in January. The claim might not come until October, or the next year, or never. That gap, the time between collecting money and paying it out, is called float. And float, for Warren Buffett, is basically a free loan from the universe. Billions of dollars that he gets to invest however he wants while he waits for claims that may or may not ever come. Think about that for a second. Other investors have to find capital. They have to borrow it, raise it, charm it out of wealthy individuals, pitch it to institutions. Every dollar they invest costs them something: interest, equity, favors, time. Warren gets his capital for free. Better than free, actually, because in good years the insurance business itself makes a profit on top of the float. He's being paid to hold money that isn't his, and then he gets to invest that money and keep the returns. It's the financial equivalent of someone handing you their credit card, telling you the interest rate is 0, and saying pay me back whenever. Except the card limit keeps growing. Every year, more premiums come in. Every year, the float gets bigger. Every year, the pool of free capital Warren gets to deploy expands. Graham taught Warren how to value a company. But the float is something Graham never had. The float is Warren's proprietary weapon, something he built himself, quietly, while everyone was focused on the stock picks. This is the machine. This is what Charlie's quote was pointing at. Show me the incentive. The incentive for Warren isn't to pick the best stocks. It's to control the largest possible pool of free capital and deploy it into the best possible returns. Everything else, the stock picks, the company acquisitions, the folks he interviews in Omaha, is downstream of that one structural advantage. In 1967, Berkshire's float is less than $20 million. By 2023, Berkshire's float is $164 billion. $164 billion that Warren Buffett gets to use for free every single day, while you and I are trying to figure out if we should put our savings in a high-yield account. And that is when the world finally starts paying attention. But here's the beautiful irony. The story the public latched onto was completely different. This is the part that changes how you think about money. The game was never about working harder. It was about understanding the system and building leverage inside it. That's what the financial restart system teaches. Not how to grind more. How to build the foundation that works while you sleep. The difference between Warren and everyone else wasn't effort, it was structure. Get the book link in the description. And if you want to go deeper, check the pinned comment below. The public was completely buying the "I just buy good companies and hold them forever" story. Coca-Cola, American Express, See's Candies, Apple. These became the iconic Buffett narrative. Patient investor, long-term thinking. Boring is beautiful. Just hold. Don't panic. Trust the process. Books were written about it. Business schools teach it. Financial advisors quoted in presentations. Be fearful when others are greedy. Be greedy when others are fearful. Everyone nodded. Everyone applauded. Everyone missed the point. That's exactly what Warren told everyone. And honestly, it's not even a lie. It's just not the whole truth. Those companies are real. Those investments are real. The patience is real. But they're the visible layer of something much deeper. They're what he does with the machine. They're not the machine itself. The Coca-Cola stake is possible because of the float. The Apple position is possible because of the float. Every headline-grabbing investment Berkshire has ever made, funded, at its core, by free capital from insurance premiums collected decades ago. The public saw the outputs. Nobody asked about the engine. The whole truth is a machine. A machine built from insurance premiums and dying textile factories and a professor who said no to a kid from Omaha. A machine that generates unlimited free capital, compounds quietly for decades, and turns a 20-year-old paperboy from Omaha into the fourth richest human being who has ever lived. Warren Buffett isn't the world's greatest stock picker. He's the world's greatest capital allocator, the man who figured out that the real game isn't about finding the best investments, it's about controlling the largest possible pool of permanent, free capital, and then pointing it at the best investments you can find. Two very different skills. One of them makes the highlight reels, the other one built the empire. And he's been telling you exactly that for 50 years. Nobody listened.